Why do some people retire with financial freedom and others struggling straight to get by, even though they may have made similar incomes before retirement? That's a question I've been asking myself since 2010. I got some great answers. And right now, I help investors achieve financial freedom by creating streams of tax smart income while growing equity for future generations. Hey everyone, my name is Brad N. Reed. I would like to encourage you to be good, and by good, I mean get out of debt, achieve your financial dreams, and give generously to your community. Welcome to the Financial Fountain of Freedom series. This is episode 12. So if you're looking for just real estate, check out the next one, episode 13. Um, Episodes 1 through 4 were about how money works, how compounding works, how cash on cash returns are useful, how equity growth is useful, multiples on invested cash, that type stuff. And I think it was around episode 5 or 6 that we started our stock market and investing discussion. This is the last one of the stock market. I'm going to talk about fundamentals and portfolio construction. And on July 1st, if you want to come live, if you are watching this video, you want to come live, check out the registration link in the description. I'm going to quit flapping my gums and keep going. All right, I am building a 4-tier program. Tier 1 is all about how to get out of debt. Do you think when I mean be good, I meant behave yourself? Life's too short. Go have some fun, get in trouble. But be good means get out of debt. Tier 2 is align your body, mind, and spirit because mindset is going to determine your financial future, your relationship future, your health future, your fitness future. All kinds of futures are established by your mindset. Heard a cool study again the other day. They took some volunteers and they said, hey, we're going to use makeup and put like this real big ugly scar on your face. And then you go talk to these complete strangers and tell us how things went. And so they took the volunteers and, one by one, they used makeup to put a scar on their face. And then right before they went out to go talk to the strangers, they said, hey, wait. We need to touch up your makeup. And then they touched up the makeup and they said, okay, go talk to the people. And then they went and they talked to a room full of strangers for about an hour. Then they came back and said, how was it? And they said, oh my gosh, those people were so mean. Everyone judged me. They were biased this way, biased that way, all because of the scar on my face. And then they showed them in a mirror when they did that touch up right before they sent them out, they actually removed the scar. So the person's face was their normal face, not a messed up face. And the people reacted as if they were being judged, they were being discriminated against. So the whole point is what's going on inside your mind that makes you observe the world in a different way than it could be. If you look at investing books, investing videos, at least half of them are about your mindset. So stage 2 is about getting your mindset right. Right now, we're in stage 3, dominate. Invest for success. Learn how to build multiple streams of income, tax smart incomes, even better. Build businesses, learn how to invest for yourself. Stage 4 is about living your dreams. Once the money is coming in faster than you can spend it, how do you be responsible with that? How do you give generously without giving it all away, right? You've built this big giant sunflower farm. You've built this big giant financial fountain of freedom. How do you give generously and keep it coming? Wrong button. That's the right button. This is not financial advice. This is for education. Hopefully there's some entertainment value only. What am I talking about? I know there's entertainment value. I hope there's some education in it for you. But you should not take anything in this presentation as advice or recommendation. I might tell you what I do, but that doesn't mean you should do it. We might talk about some things that you can buy or sell, but that doesn't mean that you should buy or sell, nor is anything in this an offer, right? There will be no offers here, no investing advice, tax advice, accounting advice, or legal advice. Should you want such personalized financial advice, seek a competent, preferably licensed individual in your area. All right, I want you to build your own financial fountain of freedom. These are the steps. Money mindset is first. Get your money mindset right. You need to calculate your desired rates of return because the biggest fiasco I think people make in their investing for retirement is that they do not account for inflation. They don't understand that inflation is going to quadruple in a 36-year period at 4% inflation. In fact, some of us went to a webinar over the weekend by this investing guru, and he didn't say it like this, but even with his strategies, this 9-figure teacher of investing basically said, you better die before your money runs out. And he didn't have an answer for that. So go grab this calculator. I can click there and I can get the link, copy that, and I can put it in there. And my buddy Bijan helped me realize, Brad, you haven't been sharing that with everyone you just host and panelists like a newbie to webinars. But yeah, it's in the chat pane. If you are watching this on YouTube, it'll be in the description box, or you can probably just hit pause and type that into another tab. But that is my inflation adjusted retirement calculator. It'll tell you what rates of return you need to account for inflation and live the life that you want. So calculate your desired rate of return. And if you need help with that, check out episode 3 and episode 3.5. Once you know your desired rate of return, structure a great portfolio that is diversified, non-correlated with asymmetric risk reward that is balanced between these classes. Real estate should be the bulk of your profile, maybe not your profile, but Peter Maluk says for his high net worth individuals, they have the bulk of their wealth in real estate, followed by private equity. Only then 15% is in public equities like stocks, followed by energy and alternatives. I talk about stocks first because you don't need to be accredited. You can find some of these others without being accredited, but sure does help if you're accredited to get access. All right. Be sure the portfolio that you build serves your needs for cash on cash and equity growth. Bijan and I have investments now. It's a real estate investment. You must be accredited, but if you're interested, swing over there and you can look at the contact page and schedule an appointment on our calendar. Please don't do it unless you are accredited and interested in learning more about investing in real estate. All right. Last thing I want you to remember is how we learn. You're only going to get 10% of a skill by watching these videos. You're going to get the rest of the skill by talking with others, like a peer group, which is why we formed a small group to go to that stock trading webinar I was telling you about. And then 60% by doing it. If you were here early and you heard us talking, Bijan and I and Sam were chatting about back trading. That's the doing it. That's the practicing part. All right, so last video on the stock market education. Next is multifamily real estate. Going to talk about some of that probably for about 12 weeks, maybe 6 to 8 sessions. And then I'll go into a little bit about private equity and energy because a lot of the formulas that we will use for multifamily will work. Maybe not the formulas, but some of the theories will apply to these other asset classes. All right, some key terms here. I have a Schwab referral code if you are interested in opening up an account. I'm not sure where I'm grabbing this one because everyone here already has an account, but if you want to use my referral code, that'd be nice. If you are watching this video, it will be in the description box. I would greatly appreciate it. The reason I use Thinkorswim, they have great back trading programs. They have great charting programs. A lot of these others are fine. I like Thinkorswim the best. You need to understand what a market maker is. Market maker is someone that creates the market. And so when you go to buy or sell, you are not dealing with your broker. Well, brokers where you enter your trades, but the market maker is the one that actually executes the trades for you that the broker sends to the market maker. You do not deal directly with the seller. So if you want to buy something, whether it's shares or options, you will pay the ask. The market maker will take your money and try to find a seller to take the other side of your trade. Now, if you're doing stocks, the market maker will not take the other side. They will only find you a seller, match you up with the seller. The buyer pays the ask. The seller receives the bid, which is less than what the buyer paid. The market maker keeps the difference. That's called the bid-ask spread. If you're doing options, sometimes the market maker will take the other side. And if they have to, and it's a type of trade that exposes the market maker to big risks, then they will demand a big bid-ask spread. For Sam and Bijan, if y'all noticed, when we were doing credit spreads, they were getting filled at the mark almost every single time. And that's because the market maker's downside is very limited. Market maker has almost no downside. But if you're doing a directional call or directional put, either buying or selling, the market maker may have to take the other side. So you don't get as good fills. All right, use candles. You get a lot more information. They may seem confusing at first, but after a couple of years, just kidding, a couple of weeks and months of looking at them, you'll get the hang of it. Candles are better because the wicks tell you a lot of information about what is going on between the buyers and the sellers. You must have a trading plan. If you were here early, you heard Bijan, Sam, and I talking about back trading. That's one of the steps in testing your trading plan. But your trading plan is developing a set of rules. When we were at that webinar, we got a set of rules, and so now we're testing them. Put those rules in your trading plan and follow them. There's 4 phases for really thorough, adequate trading plan testing. You can get a trade journal here that I have built. I'm not sure. Excuse me. I'm not sure if the formulas are right. I believe that they are, but check them. Put them into your AI and change them as you need to. All right, today we're going to talk about fundamental analysis and portfolio construction. And then we're going to talk about what events cause you to want to go in. First, portfolio construction. I divide my portfolio up into several buckets. You decide how many buckets you want. Pretty much for me, it's 2. There'll be a swing trading bucket. This one is a lot of technical trading. I studied technicals like double tops, double bottoms, head and shoulders, moving averages, volume weighted average price, candle patterns like hammers and dojis, and stocks that are gapping, all that kind of stuff. So that's my familiarity. Fundamentals is not my strong suit, which is why I saved it for the end. So I will be more of a reporter in this episode rather than a expert. I'm a reporter, not the expert. Trading tends to be shorter holding periods, all of that kind of stuff there. Long-term investing is more about the fundamentals. It's about how is the company performing? What is the company? How stable is the company? And it's more of a, months to years holding. You care more about the performance and the management and the industry. And if it's a good company, the idea is over the long run, you will come out much more ahead than if you just traded stock market ETFs. With trading, swing trading, day trading, you're looking for that quick little move. It's like a surfer. You don't surf, you don't paddle out into the middle of the ocean to catch a wave. You don't ride the wave all the way up onto the beach and the rocks. You ride it for a little bit, you have fun, you get out, and you go find the next one. So while I have these 2 buckets, you may have more, but I am going to be using credit spreads to put my money to work while I'm waiting for my swing trading setups to appear. And if I have chosen some companies that I want to invest in for long-term investing, while I'm waiting for them to come down to their buy price, I'll be doing credit spreads to put all of that to work. Credit spreads I talked about in the last episode. So when you're looking for a company to invest in, start with what you know. What are you familiar with? Maybe you have a nice long career in an industry. Maybe it's healthcare, maybe it's tech, maybe it's automotive. I don't know. Whatever you worked in, look for companies in that first, the ones that you know. Think about what you buy, what you consume, what restaurants do you go to, what sneakers do you buy? It seems like over the weekend, several people liked to trade their shoe company. Um, but what are the companies that you use all the time? And then go do research on those. And then lastly, I like being diversified, right? The whole point of Ray Dalio's investing is to get diversified, non-correlated with asymmetric risk reward. So if you start with what you know and then you move to what you use, there still may be some sectors that you're lacking. So here is a list of sectors. You can go to spdr.com, called the spiders or the speeders, depending on who you're talking to. They've got 9 or 12 sectors. I don't remember. But the idea is that you eventually keep learning about companies, eventually keep learning about, Sam says there's 11. Okay, awesome. Thank you, Sam. But you keep learning about different companies and different areas until you have one or two good companies across multiple sectors. Every trade that you do, every investment that you do, you are looking for asymmetric risk reward. I misspelled that. I'm going to fix it right now. I think I am. All right, I fixed the spelling so you don't have to send me any hate messages on YouTube. The idea is get a diversified portfolio inside of the stock market with every opportunity to have a significantly greater reward if things go right than risk if things go wrong. Again, I look for a 2-to-1 reward risk ratio minimum. So I wanted to share with you one of my dad's strategies about dividend paying stocks. So some companies are called growth companies because they reinvest a lot of their cash into capital expenditures and other ways to make the company grow. Sometimes that's building things, sometimes that's buying things, sometimes that's marketing, whatever. Other companies pay their extra cash to their investors. So one thing my dad likes to do, y'all remember how to do a cash secured put. He likes to sell puts on companies that expire just before the ex-dividend date. So before a company pays a dividend, usually it's 2 to 4 weeks before that dividend date, there's something called a record date. And you must be an owner of that particular stock on the record date in order to receive the dividend on the dividend date. Now, when you go to your broker and you push the buttons, it takes 1 to 3 days. I think now it's 1 day, but some of y'all may be using some funky brokers that still take 3 days for the trade to settle. So the ex-dividend date, I think right now it's 1 day before the settlement date. But just to be safe, I would do at least 3 days before the settlement date, or execute my trade, or let that put expire at least 3 days before the record date, so that if you get put the shares, you collect a dividend right away. And if you don't get put the shares, you got the premium from your put. You still have your liquid cash. You can go do another one. So once again, sell a put, set the expiration to be a day, two. I like 2 days before ex-dividend date, but suit yourself, do your own research, seek a competent and licensed individual in your area. Your broker would be a great person to ask if you're going to do this strategy. Once again, if you're assigned, you get the dividend and the premium you keep, of course. If not assigned, you get the premium and go do it again. Thanks, Dad, for sharing that. My dad's here, by the way, if y'all are watching the video. All right, now, how do you get into a stock that you want? Let's say you find a stock, it's coming down towards your buy price. How are you going to enter? I like selling cash secured puts if I have enough money to buy 100 shares. If I do not have enough money to buy 100 shares, I will put in a buy limit order. And you can leave it as a day where a day order that your broker will delete it at the end of the day if it's not filled. Or if you see DAY on your broker's order form, you might be able to change that to GTC, which will stand for good till cancel. Talk to your broker. I don't think I've seen those last more than a year. So either 6 months or a year, your broker will cancel it if it hasn't filled yet. But the idea is that you can set one order and leave it out there for a couple of days or weeks until it gets filled. one thing to consider is, let's say you want 137 shares. Well, you can sell one cash secured put and you can do a limit order of the other 37 shares. Now, let's say you do want 137 shares, your buy limit order fills for 37 shares, and the stock gives a very strong reversal signal. You were right about the price, you were right about where it's going to take off, but your put's still hanging out there, and you think it's going to go off and leave you. You can do a buy stop market order to get filled as the stock is going on up, but you want to be sure that you buy that cash secured put back. If the stock is going up, that put should be very, very cheap, because not only should theta have decayed, the value of that option, but when stocks are going up, puts become very cheap. So hopefully you sold it on a down day and collected a big premium, and then you can buy it back to close it out when the stock is going up and it's super cheap. So 3 ways to get in, and you can combine all of these to get the best price possible. So you can use these different order types in combinations to get the best basis, and your basis is the overall weighted average cost of your positions. So if I'm going to, let's say overall, I want 400 shares, I might sell 2 puts, I might do 1 buy limit order and see if it'll go down below my buy price, and then maybe do a buy stop market when I think it's about to bounce and break higher. So use all of these strategies in small pieces to get the position size that you want at the best possible price. Once you're in, protect what you are building. Covered calls are a great way to generate income while you're waiting for your stock to get to your sell price. Remember, though, if you make your covered call lower than your sell price, you may be forced to sell your shares before you want to. Be sure you are willing to sell your shares at the strike price of your covered call, or don't do it. Collars are a great way to lock in gains. Again, the idea is that you buy a put and you sell a covered call. If you do it right, you should be able to lock in a profit on your collar, and that lowers your cost basis on your stock holding. And when I say do it right, the best times to do collars are on big up days, because you gain a lot of premium for your calls and you can get them much further away from the current price action, and your puts become very inexpensive to buy as insurance. Maybe you want to keep the dividends if the stock just wants to go sideways, or whatever the stock does. You just want to keep your dividends. I always recommend buying protective puts over earnings. And you can buy protective puts for a short period of time, far out of the money. They become very cheap. I have a couple of dividend paying stocks, and over earnings, I like to buy a put that is less than the dividend I expect to receive. If the stock gaps down over earnings and I want to keep the stock for the dividends, then I can sell my put, because the put just got more expensive. And maybe I don't want that insurance policy, but someone else will pay me big bucks for that insurance policy if it gaps down far enough. You can also use protective stops or trailing stops, but just like I said, if a stock gaps down, it can gap over your protective stop and you get filled lower than you wanted. Folks, I strongly recommend having a put or a collar over earnings. All right, allocation-based position sizing. For the piece of your portfolio that's your short-term trading and the piece of your portfolio that's your long-term investing, you need to decide how much you are going to allocate to each individual trade. Now, for your swing trading, day trading, shorter term trading, your technical trading, I love the R system. Go back to the episode about trading plans and position sizing and use the R system. If you're investing, take 10% of your investing bucket for each stock that you're going to do, assuming you're going to have 10 stocks. If you're only going to have five, then 20% on each. Do what's right for you. For me, I'm going to aim for 10 stocks that I want to buy at their buy price. And so therefore, my investing bucket, I will put 20% for each stock that I want. And then, of course, when I'm doing my credit spreads while I'm waiting for the stocks to get to their buy price, I will have that. I will use that cash and keep it growing. All right, choose allocations and trade strategies that match your goals. How often do you want to check on your positions? Do you want to check them every day? Do you want to check them every hour? Do you want to check them every 5 minutes? I have been in those. They are lots and lots of fun, but they are a lot of time. I don't have that kind of time right now. So my strategies right now, pretty much I'll check on them once a month. What are you good at already? Are you good at strangles? Are you good at credit spreads? Are you good at buy and hold? Or maybe you're good at buying double bottoms off of support and getting a 2-to-1 reward risk ratio. Do what you're good at. And then while you're being good at stuff and spending the amount of time you want to spend, start studying on what the next thing is. If y'all notice, I'm talking about several different types of stock trading strategies. I'm going to talk about multifamily investing strategies next. And then I'm going to talk about private equity and then talk about oil and gas. I've been doing this for a little bit and I'm always learning more. Diversified, non-correlated, asymmetric risk reward spelled correctly. You may have heard me talk about that a bit. All right. A lot of people like to have a speculation bucket. Whether there's a big headline ticker like SpaceX, your favorite private company is going to go public, or you just like trading the penny stocks because you think you can buy the company for 10 cents that's going to go to $1,000. Whatever it is, if that's what floats your boat, that's fine. I don't want you to starve yourself from how you have fun. But in my view, unless you are very, very skilled, unless you have a proven track record, it's gambling. So take your shot if you want your shot, but do not confuse investing and gambling. So if you're going to have a speculation bucket, keep it small. Know what the heck you're doing. For God's sakes, control your risk. Don't chase. If you miss it, stick to your plan. By the way, a lot of IPOs do what's called a Weibull distribution or bathtub curve. As soon as they open, they run up. And then within a month, maybe 2 months, they fall right back down to where they opened and usually go a little bit lower and then go sideways. That's what I look for. I look for that up, sharp down, and then sideways action. And then I trade the breakout of that sideways action. So if you see an IPO do that, give me a call, send me a text. Use your option skills to limit your downside. And remember, you can do long calls, maybe out of the money, like at 0.25, where if you're right, you will gain delta quickly. If you're wrong, you will lose delta slowly. And remember to buy a lot of time so theta does not decay the value of your option. But options are a great way to limit your downside because the worst thing that can happen is that option go to zero. So if you buy $100 worth of options, they go to zero. That's what happened, but the upside is basically unlimited and you have leverage. All right, here's some stuff I pulled on taxes. I'm not an accountant. This is not advice. This is something I found off the internet. There's a difference between short-term gains and long-term gains tax. Talk to your accountant, find out what it is. Guys, make sure your accountant can do basic math. I had a buddy that was investing and he found something and it went up 30% in like 4 months. And I said, dude, wasn't your goal 10%? Are you going to sell? He says, no, my accountant tells me to wait a year and then when it's up over 10%, sell. I'm like, all right, so this genius is telling you that it's better to pay 20% taxes on a 10% gain than it is to pay 30% taxes on a 30% gain. Throw that into AI if you can't figure out that 21% is greater than 8%. Made me so mad. I'm completely over it now, by the way, as you can tell. All right. Watch out for something called the wash sale rule. If you sell the stock and then buy it back within 30 days, any loss that you have, the IRS disallows it. That's a fancy term. It affects your taxes. I'm not going into it. Talk to your broker, talk to your accountant, and pay attention to dividends. Some dividends are taxed at different rates than others. Talk to your CPA. Don't talk to me. I don't know. I'm the reporter and a bad one, a bad reporter on this one. I am not the expert. All right, let's talk about picking companies. All right, a lot of this is going to come from Warren Buffett and his teacher, Benjamin Graham. But the idea is, or one of Buffett's quotes is, the stock market is a voting machine in the short run. In the short run, the buyers and sellers, they vote because they're buying or they're selling, and that determines if the stock is going to go up or down in the short run. But in the long run, good companies win better than bad companies. So if you're looking at trading and short-term stuff, that's why we focus on technicals. If you want to invest for the long run and you want to catch a company that's going to make a long run for months, maybe years, maybe even a decade, and you're going to be using your option strategies to maximize all the returns that you can, that's investing. That's when you want to buy and hold. That's when you want to sell your puts to get in, sell your covered calls, buy your protection over earnings. But if you pick good companies, they will get higher over the long run, unless something changes, of course. All right, one of the first things to look at, Warren Buffett calls it an economic moat. What is it that makes this company special that no other companies are going to be able to compete with it anytime soon? So these moats come in various flavors. The brand is the easiest one. What is your favorite brand of fill in the blank? And then some people, they just go back to that same brand. Like I know my son loves Nike shoes and Nike shirts and Nike sweatshirts and Nike this. My wife and daughter, they love Lulu. So if it's Lululemon, they want to buy it. That's called a brand moat, and several companies have that. Think Coca-Cola, think Apple, think Netflix. You just know the brand. If the brand is a verb, like Google it, or back in the days, Xerox it, that's an indicator of a good moat. Network effects, things that work on certain networks. Um, I'm old enough to remember when you would go into a store with a credit card, it would either be Visa or MasterCard. And if you didn't have the right card, you couldn't pay. Think about gas stations. Gas stations used to have their own credit cards. And if you had a Shell credit card, you could only use that gas card at Shell stations. So that's a type of moat. Regulatory barrier. If the government won't let you change, that's a problem. Excuse me, not a problem. It's a moat. But a lot of utilities companies have regulatory barriers. It's very, very hard to get in. Um, think of also transportation companies. Railroads are the thing because they own the tracks and no one else can use the tracks without their permission. Switching costs, things like Salesforce, Oracle. Some of y'all are Apple people. Some of y'all are Windows people. There's a cost to switching from one to the other. And some moats are cost advantage. Costco, Amazon, they can sell you the same product cheaper than just about anyone else. And if you have any of these moats, it pretty much means that your customer base is going to come back to you, and it's going to be very difficult for a competing company to take your customers. So if you are looking for a company to invest in, make sure that it has a very strong moat, maybe two of them. The next thing you want to look at is management quality. Bijan and I talk about this all the time when we're looking at real estate deals. A bad operator can sink a good deal. A great operator can save a bad deal. Just seen it too many times to believe any differently. It goes the same for the stock market. If a company has a great CEO, the stock is likely to go up, at least compared to the market. If the market's getting hammered, maybe that company goes down for a short time, but it should bounce back quickly, or maybe it doesn't go down as much as the overall market. But look for companies that have great CEO. Do the managers of the company own stocks of their own company? Because if the management doesn't believe in the company, why should you? How do they allocate their cash? Talked about this a little bit earlier. If a company has cash, do they acquire other companies? Do they reinvest in the business, spend on capital expenditures, new plants, new trucks, new whatever, maybe more marketing, more sales? Do they buy back their own stocks? Now, sometimes this is an employee retention uh, benefit, right? They give their own employees stock options or stock shares, and so they, as their employees sell it and they hire new employees, they got to buy back their own stock. Sometimes it means that the company thinks that their stock is going to go up, so they're buying it. If the company is buying their own stocks, it may mean that if you own it and it goes down, that that company will buy back their own stock, keeping the price high. Dividends can sometimes be a warning sign. Some people see a company that spends their money to encourage their investors. It means that the managers don't have any ideas on how to make the company better. So they're just going to give the dividends to their investors. So find management that is going to allocate free cash flow like you would want them to do if they were running your business. Are they honest, right? Look at past guidance and future results. Do they say what they're going to do? You can get a lot of this information from 10Ks if it is a US based company. And this is going to be a plug for US based company because the annual reports, the 10Ks, are the quarterly reports, but these reports are highly regulated by the US government. Good managers are going to tell you what's wrong. They will describe what is ugly about their baby. So if you're reading these reports, quarterly reports, annual reports, and the managers say, look, these are the risks, these are the problems, and this is what we're doing about it, pay attention to that. That's a good thing. A lot of really good CEOs will actually write a letter to the investors. Sometimes they apologize. They're like, hey, I screwed up. I'm sorry. Man, when they admit their own mistakes, you know, a manager that's going to be honest with me, I almost trust them more. Well, I certainly trust them more than someone who just wants to tell you it's sunshine and rainbows, even when it's not. And then lastly, is their compensation aligned with the company doing well? All right. I like looking at growth numbers for growth stocks. There's a bunch of different growth numbers here. Revenue, book value per share. Book value means if you were to sell everything, what is it worth? Free cash flow, that's after all of the stuff that's been subtracted away. So it starts with revenue, then expenses for doing business, and then you get your EBITDA, your earnings before income taxes, depreciation, and amortization. Then after you have taken away the cost of business, you take away the cost of structuring that business. A lot of times if you've taken out loans, other types of long-term stuff that isn't in the business, it's on the business, that gets subtracted. Then you get profits. Then after profits, what do you do with the profits? Do they reinvest it back into the company? Are they are they spending money on capital expenditures? But after all of that expenditures is the cash. That's what's left over. That's why a business can have massive profits and the owner be broke as a joke because profits are different than cash. And if you don't know that, you can get hurt real bad. All right, earnings per share is a good one. Sales growth, can give an idea of how the company's doing compared to its market. Pick your favorite, look at all of them, use your AI to go pull these numbers quickly and efficiently, but make sure your AI is doing it correctly. Question for y'all. What is your inflation adjusted retirement growth requirement? Did you calculate that? Because this sure would be a good time to know it. If you're shooting for 18% growth, but you're picking stocks that are doing 8% growth, spoiler alert, that ain't going to do it. Go grab that calculator. It's in the chat pane. It'll be in the description if you're watching this on YouTube. Pick stocks that match your goals, please. All right. If we're talking about efficiency and health of the company, return on equity is a great number. The money that's invested into the company, the equity, what is their return on that? Debt to equity, is that company and their successes, is it because they had really good operations or because they borrowed a bunch of money? Some of these companies have 8 to 10 years of debt, some more. That's not always bad if it's something like a utility company or an oil company where it's pretty solid. They're going to have a customer base in 8 to 10 years, but the lower the debt to equity, the better. And profit margin. What is their actual profit margin? Higher is better than lower. All right. Price to earnings. You've heard me talk about this in relation to the Shiller PE ratio. What is the price that you pay for a dollar of earnings per share? So every dollar that company makes per share, how much do you have to pay in a stock price? Compare it to other companies within that market or within the sector, because different sectors or industries have different PE ratios. I remember when Tesla was selling at 1,600 price to earnings, maybe it was 1,200, but it was insane. People were buying Tesla at a price that it would take that company over 1,000 years to get to break even at the current earnings. Now, obviously, situations like that, they think the earnings are going to go way up. Just know what you're buying. Look at the price to earnings. Now, here's where we are looking for a golden opportunity. Good companies, every now and then, have problems. And because a company has a problem is when the price is going to get low enough that you want to buy it. Your job is to figure out the difference between a temporary situation and a long-term situation. Is this problem temporary and the company is going to be a great company again, or is this something permanent? There's been something that changed and this company no longer has an advantage and it's going down, maybe going to zero. So think about COVID. Everyone got sick. We had government shutdowns. It should have been relevant that that was a temporary problem. Maybe there's bad weather. Maybe a company has all of its operations in a hurricane zone, and a hurricane comes through and shuts down the oil refinery for a month. Product recalls. I've heard about Chipotle a couple of years ago. They had norovirus and then E. coli. Those kinds of things were temporary, and the company came back. Maybe there's a new competitor that everyone thinks is super hot, but the company that you like is big enough to buy them out. Permanent problems. Think about Enron, Wirecard. Think about technology, right? When Netflix showed up on the scene, we should have known that Blockbuster was in trouble. When Amazon showed up on the scene, a lot of the retail companies may be in trouble. If the company's in a lot of debt and interest rates go up, that happened recently, that's an issue. If they had a patent and the patent run out and they're not having any more patents, that is another issue. All of these are examples of permanent problems. You need to dig into why a company is on discount and then find out if it's a temporary problem or permanent problem. All right, read the 10K earnings report and look for all of these things. Guess what? You can put all of this in your AI and say, hey, AI, go pull the 10K and tell me what they talk about for the moat. Tell me what they talk about the competition. What does this business actually do? What industry is it in? What does it say the risk factors are? What is the management talking about? What does it say the problems are? You can put all of this AI, pull these financial statements, interpret the financial statements for me. Go find me a formula based on these financials, what the stock price should be. Now, again, you got to check it. You got to find out what works for you. You got to test it and go back to the trading plan about how to test it. Warren Buffett and Benjamin Graham have written tons of books, tons of formulas about how to take these annual reports and 10Ks and determine what the stock price should be. So read Warren Buffett, read Benjamin Graham, use your AI to go figure it out. All right, another thing, you can find the gurus and you can track the gurus, because when the gurus make trade big money, they have to file reports with the SEC on what they did. So you can go look at what they did. If there's a company you are interested in, you can look and see what gurus are buying or selling or holding the stock that you love. And many of these gurus have ETFs that follow what they do. So you can, just buy the ETF and it will track the guru for you, you hope. All right, put it all together. Build yourself a watch list of companies that you want to invest in. Look for their buy price. Calculate that buy price. I like limit orders and cash secured puts to get me in at the target where I want to get in. Always have protection, especially over earnings. And watch the companies, monitor them, see if anything changes, and use your technicals to get out at the very possible high if you can. If you want to just collect your dividends, again, watch the company, make sure nothing changes for the worse. All right, folks, that concludes the stock trading section of Financial Fundamentals. I got that one done in under an hour. So go back to previous episodes if you missed something. Again, you are only going to retain 10%. You can only get 10% of the skill by watching videos, reading books. You got to talk to people. On July 1st, I'm going to jump into market analysis of multifamily real estate. I will go fast. You can hit pause if you want to follow along click by click on the video, but that is coming July 1st, episode 13. So your money mindset determines your future. Calculate your desired rate of return. Structure a great portfolio that is diversified, non-correlated with asymmetric risk reward. Peter Maluk says, have the bulk of your assets in real estate. Next, private equity. For his high net worth individuals, only 15% of their assets were in public equities like stocks. So stocks are great if you are not accredited. If you are accredited or you are savvy and have access and you're non-accredited, start looking at those other asset classes. The problem is that the stock market is 80% correlated. All of the stocks are 80% correlated with each other. All of the public equities are 60% correlated with each other. And the holy grail of investing says get assets that are non-correlated. So 15% in public equities, 10% in energy, 5% in alternatives. Make sure it serves your needs for cash. We have investments now. Be sure you discuss your strategies with others, or even best, get a small group of friends and all study this stuff together. All right, folks, that's where you can follow me on social media. If you think I've been talking fast, it's because my wife just told me we are under a tornado watch. I'm going to go to the basement. Love y'all. Thanks for carrying with me through all of this stock trading stuff. I really do think this stuff is a lot of fun. Real estate is funner. And yes, I just used that word. All right, folks, hit me up on social media if you have questions. Come back on July 1st for multifamily investing. And as always, trade on logic, not on hope. God bless you.